What's going on, folks? Thanks for being here with me. And it definitely appears like the cracks in the empire are starting to appear. Two of the most powerful hedge funds in the world, Citadel and Millennium, have suffered unexpected losses. Honestly, it's exposing some of the structural weaknesses in their pod shop model. And it's raising serious question about the stability of the firms and the risks that they pose to global markets and potential spillover effects for retail investors, including those that have no idea about anything that's going on. 401k, thrift savings plan, IRA, ISA holders. What's going on, ladies and gentlemen? Appreciate you. What's up, Daniel, Road Dog, Giles, and ladies and gentlemen, welcome back. So basically, the pod shop model, it's pod-based hedge funds, and they operate differently from traditional single manager firms. Instead of having like one single central investment strategy, they divide their money amongst hundreds of small independent teams. They call them pods, and each one manages its own strategy and its own risk profile. What's going on, Diaz? Thanks for being here, my brother. All of you Lit Exchange founding members, appreciate you. Now, these firms, these pods, they make money through diversification, risk controls, rapid capital reallocation, moving their money around, and high turnover. They spread their risk across multiple strategies and have strict limits on leverages and drawdowns. And if losses exceed a certain threshold, well, they cut them off. And the capital is dynamically shifted between successful and underperforming pods to prevent any major issues. But the portfolio managers here operate under extreme pressure, and there's very high turnover, and underperformance, of course, leads to immediate dismissal. And this structure has led to years of market-beating performance by firms like Citadel, Millennium, and Point72 and others. And their ability to quickly adjust to volatility has made them dominant players in finance in general. But despite these strengths, the pod model shop is far from invincible. They've had recent losses suggesting weakness in some very key areas. They have a simultaneous strategy correlation here, and basically it's hidden risk. And the pods are designed to be independent, but in volatile conditions, like we've seen over the last couple of weeks, or should I say the last 6 or 7 weeks, the different strategies can unexpectedly correlate, leading to multiple pods losing money at the same time. And if many pods take losses simultaneously, well, the firm's overall risk buffers are tested, leading to potential margin calls. So a lot of what people have been seeing lately in regards to tariffs and other issues are really just a tiny portion of the issue that we've been seeing on the drawdown. A larger part of what we've been seeing on capital markets, financial markets, is really due to the reallocation of funds by these firms and their shifting of strategies as they're realizing, hey, we're losing money. We need to cut our losses. We need to sell some of these assets and move on. So there's obviously liquidity risk and forced unwinding of positions. And as you can see here, Citadel and Millennium losses expose a lot of the pod shop vulnerabilities here. But I'll recap this. I don't want you guys, we can read the article if you want to, but I'll give you what this actually means. So basically, they rely on rapid capital reallocation. And if multiple pods need to cut their losses at the same time, they are forced to sell large positions quickly, driving down asset prices and amplifying losses. Hence, the huge drawdowns we've seen on the SPY, the Dow, the NASDAQ over the last couple of weeks. Again, it's only really been about a 10% correction over the last 6 weeks, which has happened many times in the past. But this can create a negative feedback loop where their own risk controls actually accelerate the losses instead of containing them. And their over-reliance on leverage here, while pod shops enforce strict risk limits, right? They have many strategies that involve high leverage. And this is done in order to maximize returns on the small price movements. So if volatility spikes, if the VIX runs, if the SPY drops quickly, etc., or liquidity dries up, even these small downturns can trigger a huge wave of position liquidations. Now, of course, that leads to issues within the companies. So the good managers there that are working under this extreme pressure, when they lose money, they get fired quickly. And there's just this huge revolving door of traders. It creates an environment where traders take excessive short-term risks in order to avoid being cut. And the firm's loss, the firm loses the experienced talent in volatile marketing periods. So the pod shop hedge funds have basically grown trillions of dollars in assets across multiple asset classes. And when firms like Citadel and Millennium take these unexpected losses, the risks extend far beyond their balance sheet. We're talking market-wide volatility. That's a huge part of what we've seen. It hasn't just been people selling off because of tariffs or uncertainty or this or that or, cryptocurrency, blah, blah, blah. The pod shops trade across stocks, bonds, commodities, currencies, gold, silver, etc. You guys have seen gold hit new all-time highs exceeding $3,000 an ounce. Silver reaching the $34 and change an ounce again that we have not seen in years now. And when they're forced to unwind these positions, it can trigger broad market sell-offs, right? This hurts both the institutions and retail investors, especially the retail investors that don't know what's going on. Oh, Rod Gordon, that's a good one, my friend. I won't even read that one out loud. People can read that one for themselves if they want to. But these firms, you guys, when they're forced to unwind positions, it triggers broad market sell-offs. And they're basically liquidity providers for everybody. They're retreating from these positions. It can lead to a wider bid-ask spread, lower market efficiency, and increases and then drops in volume. And what we've seen the last couple of weeks is a vast decrease in volume on the S&P 500 on the SPY. So the losses at these pod shops could lead to hedge fund contagion, spillover to other hedge funds, prime brokerages, banks, clearinghouses, traditional asset managers. And if leverage is a key driver of these losses, it could resemble previous financial crises, where margin calls create a domino effect in global markets. In case you're unaware, 2008, S&P 500 saw its worst day in history. And not even 15 days later, we saw Volkswagen run up to $1,000 a share, becoming the world's most valuable company in terms of market capitalization, simply due to the fact that Porsche owned only 55% of all Volkswagen shares. Now we know for a fact that retail investors own over 90% of all AMC shares, and pretty much the same could be said for GameStop as well. GME is right up there with it. A huge number of shares DRS'd and a significant number of retail investors. The sky's the limit with these kinds of stocks. You guys saw Robinhood, Webull, IBKR, and a dozen other hundreds of brokerages pull the buy button on these securities in the past when this massive volatility began to take shape. And it's looking very likely like something like that might just happen again. We could be seeing the beginnings of a mother of all short squeezes start to take effect here. Retail traders that aren't paying attention could get crushed. If hedge funds and their hedge fund liquidations trigger a market downturn, retail investors that are not paying attention, that are not aware of what's going on, could see their portfolios plummet. Increased volatility could trigger stop losses or margin calls for traders using leverage, leading to forced exits at the worst possible prices. Is this a temporary setback? Is this a bigger crisis? We're going to have to see what happens here as we proceed and the Trump administration continues to make these changes. Obviously, in my opinion, I think they're very good changes, and something's got to give. And most of the time, that's overvalued asset classes. Like right now, what we're seeing with real estate, that we're seeing with stocks and cryptocurrencies. The losses that we're seeing at Citadel, Millennium, etc., are just a little blip, just a tiny little blip in an otherwise dominant run. Or they could be seen as a warning sign that their model of pod shops is not as bulletproof as they once believed. So the market conditions remain extremely unpredictable. Even the most sophisticated hedge funds are going to struggle to adapt here. And when these giants stumble, the shockwaves could ripple through the entire financial system. I'm talking fire sales of assets. Part of the reason why you guys saw me post a video, the fire sale scene of margin call yesterday on the channel here, or today on the channel actually. We're talking short squeezes that we've never seen before. A lot of people think that GameStop running into the hundreds, AMC and others running up 2,000% or more was the mother of all short squeezes. I got to say this. That was nothing. That was a sneeze, a tiny snippet, a moment in time in which people realized that hedge funds, especially the ones that are extremely over-leveraged, like Archegos, Melvin Capital, and so on, are fucked. Some of them have already gone bankrupt, insolvent, have had to close down, tuck their tails and run. Others, like Citadel, had to bail them out. Like UBS, Credit Suisse had to bail them out in order to maintain their own solvency. And that didn't work for everybody, as you guys know is the situation now with Credit Suisse. Now the question is this the start of a major hedge fund reckoning? Well, folks, I've got to say this. You look here, we have a post here from Wiz88, basically ODB 123 on X. And he posted up this notice from the DTCC. Now, in case you're unaware, the Depository Trust and Trust Company posted this here in regards to UBS. And what this says is that UBS is going to take over all of the toxic derivatives of Credit Suisse. At the same time, UBS is considering the sale of some of their Swiss assets from their asset management division as part of a revamp. We're talking only $1 billion. That's a lot of money. But for them to have to sell $1 billion of assets after their acquisition of Credit Suisse in 2023 and is aimed at streamlining operations does align with their growth goals for their asset management business, which has grown significantly after the acquisition. And while real estate assets in Switzerland are performing well, UBS is looking to offload these non-strategic assets. But is it to enhance profitability or is it to mitigate losses? Let's break down this DTC filing step by step so that you guys understand exactly what's going on and their connection to Credit Suisse, Archegos, Capital Management, the family office owned by Bill Hwang, who is now in federal prison for the rest of his life, and UBS. And this involves unraveling a complex financial saga that spans risk management failures, toxic derivatives exposure, and the fallout from major institutional collapses. And a lot of it is due to their over-leveraged short positions in companies like GameStop and AMC. Archegos, they collapsed in 2021. They were a family office, as I said, run by Bill Hwang. He's a former hedge fund manager, of course, because he's in federal FMNA prison. And in March of 2021, Archegos collapsed spectacularly due to their highly leveraged positions in derivatives. This comes just 2 months after the firms, like I mentioned earlier, Citadel and Virtue and other market makers and clearinghouses had to collude with hundreds of stock brokerages like Robinhood and Webull and E-Trade, etc., Charles Schwab, to prevent you from buying any more GameStop, AMC, SLV Silver ETF, COS, headphone stock, and dozens of other securities. As a matter of fact, 50 different securities. Now, Archegos had a ton of highly leveraged positions in these derivatives, specifically total return swaps, because that was their biggest exposure. And these swaps, these TRS, total return swaps, allowed Archegos to gain exposure to stocks without directly owning them. So this could amplify their potential gains and definitely amplified their losses. And their derivative contracts where one party, in this case it was Archegos, pays a fee to a counterparty. In this case it was their bank, Credit Suisse. And in exchange for a total return on the underlying asset, GameStop, AMC, SLV, etc., if the stock price rises, the bank pays Archegos the gain. If it falls, Archegos owes the bank a loss. And this also happens in the opposite direction. When Archegos shorts something, it's the opposite direction. Short means that they're going to expecting that Archegos would be making money when the stock goes down and losing money when the stock goes up. Now, they used extreme leverage and they borrowed very heavily from multiple prime brokerages. Nomura, Morgan Stanley, but number one, Credit Suisse, to amplify their bets. And at their peak, guys and girls, Archegos had exposure to over $100 billion in assets, with only 1/10 of that amount in actual capital. And in March of 21, some of Archegos' key stock holdings that they were long on, like Viacom, plummeted after a secondary stock offering diluted their value. So this triggered margin call from their prime brokers, demanding that Archegos post additional collateral to cover these losses. And they couldn't meet the margin calls. Archegos was screwed. The prime brokers began liquidating the underlying stocks in order to cover their exposure. And this led, of course, to a fire sale that further tanked the stock's prices, creating a vicious cycle. And Archegos imploded, losing billions overnight, folks. Everlong Gaming says the shell game is going on, but the shells are cracking, and we can see the golden pea. This is the way. Now, Credit Suisse's role here and their exposure to Archegos was massive. They were their prime broker and facilitated a huge portion of these total return swaps. When Archegos collapsed, Credit Suisse was left holding the bag of these toxic derivatives, suffering huge losses. Credit Suisse reported $5.5 billion in losses just from their exposure to Archegos. That was one of the largest single client losses in banking history. And Credit Suisse was, of course, criticized for their shitty risk management, and they allowed Archegos to build these massive leverage positions without adequate collateral or transparency into their actual exposure across multiple banks, because they were doing the same thing with different banks. But unlike some other banks, which exited their positions quickly, Goldman Sachs, Credit Suisse was really slow to act, and this definitely exacerbated the losses. Again, regarding the movie margin call, Goldman Sachs was the first out the door. They survived. Credit Suisse was not, and they are toast. The problem is that the total return swaps tied to Archegos meant that Credit Suisse was on the hook for the underlying stocks. And when those crashed, they had to absorb the losses because Archegos couldn't pay. Now, the debacle was a significant blow to Credit Suisse, and it was a part of a broader problem of the mismanagement and scandals that they had at the bank for several years, many years. They'd already been having massive issues with the 2020 collapse of a supply chain finance firm called Greensill Capital, where they had $10 billion in exposure and various regulatory fines for money laundering and tax evasion. Then the Archegos losses further eroded their capital and destroyed their reputation, and their stock price dropped, plummeted, and they couldn't raise capital. And by 2023, Credit Suisse was in a death spiral. They had huge client withdrawals, plummeting stock prices, just a liquidity crisis that culminated into a government-orchestrated takeover by UBS in March 2023. And the Swiss government and regulators facilitated the deal to prevent a broader financial crisis, as Credit Suisse was deemed too big to fail, quote unquote. You guys know what that means, right? What's going on, Fugazi? Great to see you. Nope says the music has stopped. That is basically what's happened with these firms. And UBS is trying to turn the knob on the music box manually for as long as they can. But that is about to end, because on March 20th, here in just under 7 days, Credit Suisse will retire their accounts. And as you can see here from this DTCC filing, let me see here. All open contracts for these accounts will be assumed by UBS Securities. Now, UBS acquired Credit Suisse for over $3 billion. That's just a fraction of what it was actually worth back in the day. And the deal was backed by the Swiss government to provide guarantees to cover potential losses. UBS knows they're going to lose money. So UBS made a deal with the Swiss government stating, hey, if we lose more than $6 billion due to this deal, then you, the Swiss government, has to give us back $8 billion or more in order to cover these losses. Of course, They were desperate, so they agreed. UBS is still holding a lot of these derivatives and a lot of these swaps. Now, UBS inherited Credit Suisse's balance sheet, which included all of their distressed assets, like their total return swaps, their other positions. We're talking toxic derivative garbage, nuclear radiation garbage, because they carry significant risk and potential for further losses. This is not speculation. This is fact, ladies and gentlemen, especially if the underlying assets remain volatile. Now, UBS has been working to integrate Credit Suisse's operations while managing the risks associated with this toxicity. And that includes unwinding or transferring the derivatives positions, which can be very complex and costly, hence the guaranteed government bailout of over $8 billion in case of a certain number of losses by Credit Suisse. By UBS. UBS knows they're going to lose a ton of fucking money, and they have not yet realized all of those losses. Yes, Gurke, for real, my friend. I would not make something like this up. You can look it up for yourself. Ask your favorite AI. Google it. Check it out. Don't take my word for it. Take the information I'm giving you and just do a little homework on it, and you will see just how dangerous this is. So let's analyze this notice dated March 11th in the context of the events that we just spoke about relating to the collapse of Archegos and Credit Suisse due to their short positions and over leveraging against companies like Gamestop and AMC and the SLV ETF, etc. The DTCC provides clearing and settlement services for financial markets. This was dated March 11th, 2025, as you can see here. The retirement of accounts held by Credit Suisse, specifically the account numbers 0355 and 0135, is effective March 20th, 2025. All open contracts, as you can see here, all open contracts under account 0355 will be assumed by UBS Securities LLC, account 0642, effective March 21st, 2025. Attention, directed to managing partners, officers, and cashiers, indicating this is a former operational notice for financial institutions. The interpretation here is that the account retiring these two accounts as of March 20th of this year, is likely a delayed consequence of the 2023 acquisition by UBS, as Credit Suisse's operations are being fully integrated or wound down. The notice specifies that open contracts under account 0355, likely the primary account tied to Archegos derivatives, will be transferred to UBS Securities account 0642. This reflects that UBS is taking full responsibility for Credit Suisse remaining obligations. Ladies and gentlemen, the best is yet to come. We haven't seen a damn thing yet. Hence, we're going to be so motherfucking rich. And I don't give a shit what YouTuber or what influencer comes out and tries to pretend like all is lost, like we are having massive problems in stocks like the SLV ETF, like COS, like GameStop, like AMC. Fucking nonsense. Fucking nonsense, folks. Manipulation at the highest level is the only thing that has kept these stocks from rising to highs that are unimaginable to the average person. Unimaginable. Now, the term here, I don't think anything is going to happen on Quad Witching Day, okay? I have been invested in these stocks for 4 years, and I don't expect a damn thing to happen on Quad Witching Day, because historically, nothing ever happens on Quad Witching Day. But the poster here, I'll give him props for putting this up for us to see. I don't agree with everything he says in regards to, I don't know if he even said anything in regards to anything happening on Quad Witching Day specifically, but it is the Pass the Bag Day. It is the Quad Witching Pass the Bag Day, which, in case you didn't know, quadruple witching happens 4 times a year. It happens in March, June, September, and December. And on these 4 days, the derivatives contracts, right? You guys know what derivatives are, right? Options, index options, futures, single stock futures. swaps, etc., expire simultaneously, often leading to heightened market volatility. Now, this aligns with such a day, and the phrase "pass the bag" hilariously suggests that UBS is being handed the problematic bag of nuclear radioactive waste toxic derivative garbage on a volatile trading day. Now, this notice, of course, does not explicitly mention Archegos, because Archegos has been long defunct, but account 0355 is likely tied to the total return swaps and other derivatives Credit Suisse held from their Archegos exposure. And these positions have been a lingering issue since 2021, since AMC and GameStop ran over 2,000%. Not once, but multiple times. Multiple times since then, we've seen these stocks go up hundreds and often even thousands of percentage points in a matter of days, if not maybe a couple weeks. And their transfer to UBS indicates that the final stages of resolving Credit Suisse's legacy issues is happening. I am not going to tell anybody that this is going to happen that the stocks are going to the moon on quad witching day. I'm not saying that the stocks are going to skyrocket next week. But Giles brings up a great point. They can't fucking close their positions. Okay, folks? They're going to have to. They're going to be forced to close their positions. Just like Citadel and Millennium were forced to close a massive number of their positions from their pot shops because of the losses that they saw over the last several weeks, further leading to the market drawdown we saw this week and the week prior, etc., right? And we ain't seen nothing yet. We're just getting started. So as these drawdowns happen, as I like to call them hedge fund babies, the blue chip stocks are their babies, right? Nvidia, Apple, right? Facebook, these fucking stocks, these over leveraged pieces of garbage with super hyper inflated PE ratios begin to reduce in value. Well, they're going to need more collateral. And they might just have to fire sale some more of these assets in order to reallocate funds or free up capital. And the notice that we're seeing from the DTC highlights UBS's role in absorbing the remaining toxic assets from Credit Suisse Archegos exposure. And by taking on these open contracts, the risk for UBS, the UBS is inheriting the market risk associated with the underlying assets in the total return swaps. And if the stocks tied to these derivatives decline further in a long position or increase further in a short position, UBS could face additional losses. And the notice's timing on quad witching day kind of underscores the potential for volatility to exacerbate the risk. And the DTC's the role here in relation to regulatory context and operational context is to facilitate the orderly transfer of these accounts to ensure market stability. The notices ensure that all the counterparties are made aware of the change and avoid disruptions for like clearing and settlements and such. The thing is that UBS has been working to de-risk Credit Suisse's balance sheet since their acquisition in 2023. And the transfer that we're about to see is part of the process. But it also means UBS has to manage the tail end risks of Credit Suisse's past mistakes, folks. Now, what are the broader implications? Well, broader implications are that there could be a fire sale of assets of some of these hedge fund babies, that there could be short squeezes on some of these hedge fund short positions. The Archegos collapse has exposed how poor risk management at major banks like Credit Suisse can lead to massive systemic issues. Banks' willingness to extend massive leverage to their clients without understanding the full exposure across multiple brokerages, prime brokers, created a ticking time bomb. Of course, this was also exacerbated with the actual retail stock brokerage firms, where they literally had to take away your ability to buy because the stocks were going way too high for their own safety. They don't care that you lost billions of dollars collectively, that we, retail investors, and I'm not talking just a few people, tens of millions of people, tens of millions lost billions, if not tens of billions, maybe even hundreds of billions of dollars. So if you're still trading on these brokerages, maybe you should consider looking into an upcoming stock brokerage that actually has the same best interests at heart that you have. And that is letting retail make money, not protecting their hedge funds. Go ahead and take a look at Lit Exchange. The link's right there. Do yourself a favor. Too big to fail, folks. That's the problem. Credit Suisse's collapse and the acquisition by UBS highlights the systemic importance of these large banks. The Swiss government's intervention to orchestrate a takeover reflects the broader concern about financial stability. Now, it's been years after the crisis. Archegos in 2021, Credit Suisse collapsed in 2023, and the fallout continues. They can't fucking close their positions. The transfer of accounts is just now taking place in 2025. That should give you an idea of how fucking long it takes to unwind complex derivative positions and integrate a failed bank's operations. UBS has to manage this toxic bullshit while maintaining their own financial stability. And they've known it all along. Hence the reason they forced the Swiss government to give them an $8 billion guarantee to cover their losses. They've already faced scrutiny over their increased size after the acquisition. And now we're seeing a dominant position that they hold in the Swiss banking sector and real estate. Now they're selling off real estate. Gee, I wonder why they need an extra $1 billion when they're such a big firm, when they've got so much money in assets under management. This just came out yesterday, by the way, where UBS is considering the sale of some of their real estate assets in their management unit. I don't think it's to increase their cash position like Warren Buffett. I believe they're expecting some massive losses as they begin to unwind this further. Now, Bacon says Lit Exchange gets started and apes transfer shares and watch their world burn. Wow. You might just be onto something, my friend. That might happen. Now, the DTCC notice for March 2025 marks a final chapter in the saga of Archegos, Credit Suisse, and UBS, with UBS officially taking over the remaining toxic derivatives. Credit Suisse's exposure to Archegos, due to their poorly managed swaps, led to massive losses in 2021, contributing to their eventual collapse in 2023. And UBS's, as the Credit Suisse acquirer, has been tasked with absorbing these liabilities, including the open contracts assigned to account 0355, being taken over by UBS 0642. The transfer on a quad witching day adds another layer of complexity, and the market volatility could amplify the risk that UBS faces. Then now the saga, if you will, is a cautionary tale about leverage and risk and the long-lasting consequences of financial mismanagement in the global banking system. At the end of the day, we ain't seen nothing yet, folks. Not a damn thing. And soon, well, now, thankfully, we've got the Doge SEC, Department of Government Efficiency, breathing down the neck of the Securities Exchange Commission. Got Trump and his firm, his team, the whole administration, well aware of everything that's going on in financial markets and the naked shorting that's occurred on DJT stock and many others in the market. If you've been following this channel for a while, you're aware that I've worked with the Robert F. Kennedy Jr. Administration and helped them figure out how to better financial markets for everybody. They're well aware of everything that's going on, and it's only a matter of time before these changes in SEC and FINRA and on the stock market begin to take place.
Elon and Doge.
We're gonna be so fucking rich.
Time to settle the score. Elon in the game, breaking all the chains. Doge by his side, they don't play no games. Step into the SEC, watch them all sweat. We uncovering the fraud, ain't no secrets left. Naked shorts in the shadows, they've been creeping. Market manipulation, these crooks been sleeping. Retail's been trapped, but we bring in the fight. Musk and Doge on the rise, taking back the night. We in the SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. We see the dirty tricks they try to pull. Shorting stocks, playing games like a fool. But we too sharp, we calling the bluff. Elon's got the plan, now the pressure's tough. Retail investors, time to get your share. No more rig markets, no more despair. Fraud's going down, we taking control. Elon and Doge breaking out of the mold. We in the SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. We on a mission, bring the truth to light. No more naked shorts hiding out of sight. Retail power, we reclaiming the street. Musk and Doge bringing heat to Wall Street. SEC, exposing the lies. Rooting out corruption, watch them meet their demise. Free the markets, make them fair once again. Elon and Doge rolling deep for the win. Hey, we on a mission, bring the truth to light. No more naked shorts hiding out of sight. Retail power, we reclaiming the street. Musk and Doge bringing heat to Wall Street. Justice in our sight. Markets are free, we restore the light. Elon in the front, Doge holding it down. They can't stop us, we taking back the crown. Fraud's uncovered, justice in our sight. Markets are free, we restore the light.